I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Let's start with a check of your first word news. President Trump is expected to tout a strong economy tonight when he delivers his first State of the Union address. He'll also call for bipartisan action on immigration reform. We will have special coverage right here on Bloomberg TV beginning at 9 p.m. Eastern Time. The president will review a classified Republican memo on alleged FBI abuses before releasing it publicly. The document alleges counterintelligence abuses in surveillance of Trump's inner circle. Now, Trump has 5 days to review that document. Speaker Paul Ryan defended the plan to release the classified memo today.
There may have been malfeasance at the FBI by certain individuals. So it is our job in conducting transparent oversight of the executive branch to get to the bottom of that. What we want is all of this information to come out so that transparency can reign supreme.
Ryan says the 4-page memo is unrelated to special counsel Robert Mueller's investigation. The FCC says the Hawaiian employee who sent an alert warning of a ballistic missile thought an actual attack was imminent. Hawaii had been testing alert capabilities, and the employee mistook a drill for a real warning. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg.
And this is Bloomberg Technology. Coming up, Apple under pressure, our deep dive into the company's latest struggles with reports of weak iPhone 10 sales and a new U.S. Department of Justice probe. The details ahead. Plus, a new alliance takes aim at healthcare. The implications for the industry as Amazon, Berkshire Hathaway, and JP Morgan join forces. And the latest status update on Bitcoin. Facebook draws the line on running ICO and other cryptocurrency promotions on its platforms. First, to our lead. The sell-off continues for U.S. stocks, with the markets posting their worst 2-day decline since August. What sparked the sell-off? Investors on edge ahead of a slew of earnings, a U.S. rate decision, and the president's address to Congress in the State of the Union. For more, let's bring in our editor-at-large, Corey Johnson, in New York. So, Corey, walk us through the highlights today.
Well, there's a lot of factors, of course, lead to a market sell-off, and the market sell-off is such that, baby and bathwater all go together. But there's some really interesting developments in the world of tech. And I think maybe most importantly, one of the things that helped lead for people to sell stocks was this announcement about this big deal, potentially big deal, at least really interesting idea of Amazon, a tech company, partnering with Berkshire Hathaway and JP Morgan to try to find a new way to solve healthcare for their employees and perhaps beyond that. Indeed, Jamie Dimon of JP Morgan saying that if it works for their U.S. employees and for their families, then it might help other U.S. businesses. That led to a sell-off in a lot of big healthcare stocks. Just a little bit of a sell-off, but after yesterday's downward move in stocks, and so long since we've had any kind of move, a lot of selling in a lot of stocks, but Amazon outperforming the market, and maybe the healthcare stocks doing worse than the rest of the market.
Right. How do you think this will impact the healthcare sector more broadly?
It is a very difficult and intractable problem that has defied a lot of the best efforts of both private and public enterprise. And a lot of the costs have to do with, better health care available for those who want to pay for it, those who can pay for it, and people getting older. And it's hard to fix the problem of people getting older. So we'll see if they can come up with some kind of solution for that. But I think, in the short term, the market reaction is kind of ridiculous. This is also, however, coming at the same time as we've had a big rise in yields and bonds. We've had a collapse in the value of bonds and moves in the 10-year, the 5-year, and particularly in the very interest rate sensitive, in the 2-year, was very dramatic. And we haven't seen this move really in about 10 years. So this kind of move in the yields offered for bonds, a rise in the yield again, and a falling of bond prices across the board is very disconcerting. You didn't see it so much in some of the European bonds. And so there's a disconnect there as well. And as a result, equities suddenly start to look weak, and the sell-off maybe starts to make some sense.
AMD earnings also crossing this, of course, in light of the massive chip scandal / security flaw that's been affecting all of the chip makers. Profit, Intel, disappointing forecast on profitability, but stronger forecast when it comes to revenue. What's your takeaway?
Yeah, I think that wasn't actually the big reason. So initially, the stock sold off a lot. If you look at the AMD trading right after hours, it was actually a pretty dramatic sell-off, well over 8% in the first moments, because you saw those words you never want to see in a CFO commentary. They were going to have to restate earnings. In other words, the numbers we gave you before were wrong. They were so wrong that we're going to have to change what we told you in the past. And so if you were to see the chart of what happened in the trading right after the announcement came out, the stock fell well over 8% as people tried to figure out what was going on with those AMD results. As you read into it, you find that there's an accounting principle called 606, and it was a way that companies, when they sell a product but have other things they have to give in the future, with the revenue recognition of the product, if they have to give services in the future, or they have a warranty that goes forward in the future, or there's software that has to be delivered over a certain period of time, there's a change in that rule, and as a result, some revenues that were recognized in the past maybe shouldn't have been. So that revenue recognition change was disconcerting because it made it look like, on first glance, that maybe AMD didn't know what they were doing or trying to hide things. What the company says is, number one, these were immaterial, but number two, that if they actually have to pull revenues from, say, 2015, 2016 towards future years, it actually could have the perverse effect of giving a slight rise to future earnings and taking away, or future profits, and taking away past profits. And as a result of past revenue, it may actually boost revenues going forward, but the kind of thing the market doesn't like to see.
Before you go, Corey, I also want to ask you about Electronic Arts. Q3 earnings in about $2 billion in revenue. Put this into context for us, given their gaming lineup this year.
So a good quarter for Star Wars, not a great quarter for Battlefield, my favorite of their offerings. But I think that maybe more interestingly, their services business is really doing well. Their FIFA business did well. The in-game purchases of people trying to build dream teams, if you like, of FIFA players and so on, really successful for this company and helping them really create a longer tail of revenues. Not unlike we were talking about with AMD, where the sale of the product isn't the main thing. It's the sort of stuff that happens over time. You never expect it from a company like AMD, but there's a little bit of the revenue mix. It's a big deal for EA right now, and that's, I think, what was really the big success in the quarter they announced today.
All right, Corey Johnson, our editor-at-large for us there in New York. Thanks so much, Corey. We'll see you a bit later in the show. Meantime, the U.S. government is said to have launched a probe into Apple. The Department of Justice and the SEC are investigating if the tech giant broke the law concerning its disclosures about a software update that slowed older iPhone models, a controversy that's come to be known as Batterygate. People familiar with the matter say the probe is in its early stages. The news comes as shares of Apple are under pressure, falling to a 3-month low. Investors are concerned about weaker than expected iPhone 10 sales ahead of its earnings report coming this Thursday. Mark Gurman, who covers Apple for Bloomberg Tech, is here with us now to break it all down. What do you make of the U.S. government now taking interest?
Yeah, it's just a banner week for Apple. We're ahead of earnings, lots of reports of order cuts. Now we're talking about the U.S. government, the Department of Justice, investigating Apple sort of scaling back the performance of iPhones in order to avoid reboots. It's interesting. It's still in the early days of the investigation. Who knows how far it will go? I think they'll end up finding out that Apple wasn't doing this to boost sales, which would be something that the DOJ would be interested in, the SEC for sure. So we'll see what happens.
Apple has, of course, responded. They, have offered the solution to replace your battery, but there is concern that that is going to put a significant dent in sales. How big a dent could that be?
Yeah, it's interesting because sometimes people were buying new iPhone models versus paying the fee in the process of going to the Genius Bar to get the battery switched out. So it'll be interesting to see if they're going to take any unit-based or sales hit from people not buying those anymore because they're going to upgrade just their batteries because it's cheaper now, only $30.
So, talk to us about these iPhone 10 cuts. I mean, are they cutting orders? What's happening?
Right. Yeah, this is deja vu. I feel like if I've been here for the last 10 years, we'd have this conversation every January for the past decade. These reports come out of the Asia supply chain almost annually, like clockwork, right ahead of earnings in the December-January time frame. What to make of it? I think Apple orders more iPhones than necessary in order to, meet their supply and demand balance. Is this going to make a big impact on their earnings? No, because I find it very unlikely unlikely that Apple will miss guidance in any significant way or even at all, because they're usually good about that, and that's what investors care about, revenue.
So you don't think there's any significant kind of mismatch happening here?
You know, it's very possible. It's possible that they forecasted they'd sell more iPhone 10s they thought they would sell more iPhone 10s than they did, but in the end they sold more iPhone 8s and older iPhones, the SE, the 6, and the 7, which isn't particularly bad news anyways, because what investors care about are the overall revenue numbers as well as the iPhone ASPs. And as Apple diversifies its iPhone product lineup, and maybe its entire product lineup, investors will have to get used to that new norm.
We're looking at the camping out happening outside the Apple Store the night before the iPhone 10 came out. Meantime, you've got a Deutsche Bank analyst, Sherry Scribner, saying that the iPhone 10 is just too expensive to fuel a real super cycle. What do you make of that?
Yeah, I don't think Apple did a particularly good job in terms of its price point marketing, because that $1,000 price point is a true threshold that a lot of people don't want to cross. For some people, that's a month's worth of groceries, a few car payments, even a big percentage of people's rent or mortgage. So that's a lot of money, and you're saying that you're going to spend that on a phone, no matter how important it is to you. I think Apple should have pushed harder on their iPhone upgrade program, where you sort of are able to pay for it over a monthly basis. They could have pushed further the fact that the iPhone 10 is basically $5 more, or a cup of coffee from Starbucks more than an iPhone 7, and I think that would have resonated with consumers stronger than a $1,000 sticker price.
Okay, so earnings coming up in a couple of days. What are you expecting?
They're not going to miss guidance. I think it's very unlikely. I don't know, so I'm just saying that.
Heard it here first.
Yeah, based on their past history, they just don't miss guidance very often. So I think we're going to see something between the $84 and $87 billion, maybe a little bit higher. I think we're going to see much higher iPhone ASP, sequentially up between 20 and 30%. But the big number I'm really looking at is Q2 guidance, according to our estimates in the Bloomberg terminal. And check out the function FAGO if you haven't already, and you can see the guidance from our analyst estimates. And what our analysts are projecting is a nearly 30% year-over-year increase from Q2 to Q2, which would be the biggest jump since 2012, which could mean that some people are waiting until the second quarter to buy new iPhones and other new Apple products. So that's going to be a very interesting number to watch, the guidance.
All right, Mark Gurman, our Bloomberg Tech reporter who covers Apple. As always, thank you so much for joining us. We'll see you back here for sure on Thursday, maybe tomorrow, because you're on every day.
Thanks.
All right, thank you. Meantime, 2 cryptocurrency exchanges are facing scrutiny from U.S. regulators. The U.S. Commodity Futures Trading Commission sent subpoenas in December to both Tether and Bitfinex. The firms share the same CEO. Tether issues a widely traded coin and claims it's pegged to the dollar, but has yet to verify that it holds $2.3 billion in reserves. Coming up, Amazon, JP Morgan, and Berkshire Hathaway are pooling their efforts to give their employees health care. While the venture appears to have big ambitions, we discuss the real-world impact for the health and tech industry. This is Bloomberg. Let's get to the other big story in tech today. Amazon, Berkshire Hathaway, and JP Morgan planning a new company to provide their U.S. employees with tech solutions for simplified care at, quote, reasonable cost. This could possibly be a massive disruptor for the industry, where rising costs are getting a lot of attention, and the trio may not be the most expected combination to plan a partnership, but what's not a surprise is Amazon's expansion into yet another sector.
There is absolutely nothing to stop this company.
Amazon's clearly a real powerhouse in the digital space, in the online space, and their acquisition of Whole Foods is a game changer for them.
The real risk here to the incumbent payments players like Visa and PayPal and MasterCard is that Amazon decides to build its own PayPal.
Amazon has been great, all the things they've done, but what we can't do is sit idly by and allow them to take our business.
This company, I think, could double from here to $2,000 per share.
They are going to be a force. They're going to be a force in content. They're going to be a force in search. As I said, 55% of U.S. product searches we calculate are initiated on Amazon. And then last but not least, on advertising.
Wherever Amazon is bumping up against the other three, it's winning. On product search, it had 44% share, 44% share in 2015. Now it's 55%. Where it's bumping up against Apple and voice, 70% share of voice in the home. Where it's bumping up against Apple and media was number 7 in percentage of share during prime time. Now it's number 3. Fastest growing media group. It's literally kicking the butt of Siri in full view of everyone. Amazon's our first $1 trillion market cap company.
Jeff Bezos had this to say about the deal. The healthcare system is complex, and we enter into this challenge open-eyed about the degree of difficulty. For more, I want to bring in our Bloomberg News healthcare reporter, Zach Tracer in New York. And in Boston, we've got Steve Krause, partner at Bessemer Venture Partners, who leads up the firm's healthcare investing activities. So, Steve, I'll start with you. What's your reaction to this?
Yeah, wow. What a week for healthcare innovation. First, Apple getting into the space, and now the announcement that Amazon and JP Morgan, Berkshire Hathaway made. I think it is all about cost for these large companies. If you look at Amazon, they spend somewhere between $3 and $5 billion on healthcare alone for their company. If healthcare is growing 5 to 7% per year, which is threefold times inflation over the last 40 years, you think about that for Amazon, that's $250 million of cost at least, and that's about 1 to 2% of their profit. So the fact that they're getting to healthcare, that they've been frustrated with the way it's worked for so long, and they're going to bring some of their know-how to try and disrupt this industry, it doesn't surprise me at all.
Zach, what more details do we have about how exactly this will work?
The really interesting thing is that we just don't know that much about how this is going to work. What we know is that Berkshire Hathaway, JP Morgan, and of course Amazon are teaming up, essentially to take on healthcare, to take on this really big cost, like Steve pointed out. They say that they're, going to look at transparency, look at doing some stuff digitally to, bring down costs or to provide care to their employees. But it remains to be seen, does this mean that they're going to try to kind of, replace some of the middlemen in the system, some of the folks who provide insurance now or drug benefits now? That certainly investors are concerned about it, but we just don't know yet.
Jamie Dimon saying the three of our companies have extraordinary resources, and our goal is to create solutions that benefit our U.S. employees, their families, and potentially all Americans. Warren Buffett saying the ballooning costs of healthcare act as a hungry tapeworm on the American economy. Our group does not come to this problem with answers, but we also do not accept it as inevitable. Rather, we share the belief that putting our collective resources behind the country's best talent can, in time, check the rise in health costs while concurrently enhancing patient satisfaction and outcomes. Steve, what kind of challenges are they going to run into?
Yeah, well, I think this is a classic buy versus build decision for them. They've been buying this for so long. As Zach said, there's been intermediaries, insurance companies, pharmacy benefit managers who have been trying to do this for these companies for a long time. And today, not surprising, their stocks are down significantly, anywhere from 4 to 6%. Companies like United Health, CVS, Express Scripts have been hit. I think Amazon and JP Morgan and Berkshire are going to try to build this. And so two things they need to do. One is that they actually need to build direct relationships with healthcare systems and with providers. They need to do direct contracting, because that's actually where a lot of the cost is. The cost of healthcare is actually care itself, and so they need to get down into where care is provided and develop those contracts. That's not an easy thing to do. Secondly, they need to bring the know-how that they have around engaging with the consumer, around paying. That's obviously where JP Morgan comes in. They have expertise in payment rails, around underwriting risk, right? It's you're talking about a broad population. You have to underwrite their healthcare risk and healthcare costs. That's obviously where Berkshire Hathaway comes in. And then Amazon comes in with the consumer engagement know-how and, frankly, the analytics and the data science around segmenting a population according to their risk and how healthy or not healthy they are. So I think they've got a lot of road to hoe. There's a lot of wood to chop, but frankly, I think a company like Amazon, they've proven to take down, as you showed earlier in your segment, almost every single industry. The healthcare economy is 18% of GDP. I don't see why they wouldn't start attacking this industry and really disrupting it.
Right. Zach, how much could this actually threaten the incumbents and industry standards? I mean, they're going to be offering this to their employees initially, but the goal, could potentially be, other customers across the United States. How much could this actually change the industry?
Well, investors are saying this threat is real. Take this seriously. Whether that's, a threat to, United Health or the big health insurers, Cigna, Anthem, down quite a bit today, or the pharmacy supply chain, is still not clear. But, I think that what these companies are going to discover as they move through this is, like Steve pointed out, some things they're going to want to build, they're going to want to do themselves, and some things they may say, you know what, we'll let United Health handle that, or we'll let CVS handle that, because they're better at it, they can do it at scale. But the mix remains to be seen, and I think that's why people are so nervous today.
Steve, will this be impacting or changing any of your investment decisions?
Oh, yeah, for sure. I mean, any venture capitalist will tell you they always think about Amazon, and now that's true for healthcare. I think from the macro perspective, frankly, the healthcare IT market has had a lot of venture capital poured into it, probably $20 to $30 billion over the last 5 years. There actually haven't been a ton of public offerings, only one last year. And I think I've always said that when the big boys, when Apple, when Google, when Amazon get into the industry, that's going to be a bellwether moment and a tipping point because you're going to see real tech strategic interest in this space. So I think on the macro perspective, it's going to affect the market. And I think for companies that are focusing on consumer, on actually drug costs, on the underlying cost of healthcare, any startup that's focusing in that area, as Zach said, these companies are going to build some of the things on their own, and then they're going to buy some things. And they might buy them from the large incumbents, but they might also buy them from the startups that have been focusing on building these innovative technologies for some time now in healthcare.
All right, Steve Krause, Bessemer Venture Partners, thank you, as well as Zach Tracer, who covers healthcare for us. Thank you both. We'll have much more reaction on today's news later this hour. Coming up, Waymo ramps up its ride-hailing plans for its driverless cars, buying thousands of Chrysler vehicles. More details next. This is Bloomberg. And a story we are watching, U.S. telecom Verizon has decided to drop plans to sell phones made by Chinese manufacturer Huawei, including a new 5G network-capable device. AT&T made a similar decision earlier this month. Both companies have been under pressure from the U.S. government. Security agencies and some lawmakers fear that 5G phones made by companies that may have close ties to the Chinese government could pose a security risk. Alphabet's Waymo plans to roll out a ride-hailing service using driverless cars this year. The company says it just bought thousands more minivans from Fiat Chrysler to make it happen. The companies aren't saying exactly how many vehicles are involved or the cost. It is the third such deal between the Italian-American car maker and the search giant. Waymo scored 100 Chrysler hybrid minivans in 2016 and another 500 last year. And Facebook has banned a whole sector of ads on its platform. And no, it has nothing to do with Russia and the U.S. elections. The social network is banning ads that promote cryptocurrencies, initial coin offerings, and binary options. Facebook says these ads are, quote, frequently associated with misleading or deceptive promotional practices. Coming up, Amazon has thrown the healthcare business into disarray, joining forces with J.P. Morgan, Berkshire Hathaway, and Amazon, as I said, to target the industry. We'll hear from the CEO of a health plan provider on the disruption he sees ahead next. This is Bloomberg.
I'm Elisa Parenti in Washington, and you're watching Bloomberg Technology. Here's a check of your first word news. Secretary of State Rex Tillerson and Defense Secretary Jim Mattis were joined by their Qatari counterparts at the State Department today for the first annual strategic dialogue between the U.S. and the Persian Gulf nation.
Qatar has made significant progress to improve efforts to combat terrorism. As a result of the Memorandum of Understanding our countries signed in July, the United States and Qatar have increased information sharing on terrorists and terrorist financiers.
Treasury Secretary Steve Mnuchin says Russia will face new sanctions following the publication of that list of Russian billionaires and top officials with ties to Vladimir Putin. Mnuchin denied delaying the report's release to coincide with the expiration of a congressionally mandated deadline to impose new sanctions on the Kremlin. And EPA Chief Scott Pruitt, Blackstone Group, we've got some breaking news. Blackstone Group has agreed to buy a 55% stake in Thomson Reuters Financial Information Unit. Now, that unit is said to be valued at about $20 billion. Bloomberg LP, the parent of Bloomberg News, competes with Thomson Reuters in providing information to the financial industry. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Just after 5:30 p.m. here in Washington, it is 6:30 Wednesday morning now in Hong Kong, where we are joined by Bloomberg's David Ingles with a look at the markets. David, here in the States, a huge sell-off for Wall Street. I don't know if we'll see follow-through there in Asia.
It does seem like we will get follow through here in Asia, extending just the global losses that actually started here yesterday. It wasn't the best of days. Let's put it that way here. When you look at the session here on Tuesday, especially across emerging markets, easily we saw losses of north of 1%, especially for the smaller markets in the Asia Pacific, which I guess sort of speaks to what might be front of the firing line when you have these yields pushing up globally. Just have a look across a lot of the markets, of course. We're already seeing declines over in New Zealand, futures penciling in quite sharp declines over in Australia, maybe a 1% drop when you look at the cash market in Japan in about 90 minutes from now. A lot of data to get through, and obviously we'll also be following the State of the Union address by President Trump. Among other things we're following, and just a whole list of earnings coming through, but it does seem overall it's going to be another risk-off session here in the Asia Pacific. And that's a look at markets early this Wednesday morning here in the region. I'm David Ingles in Hong Kong. More from Bloomberg Technology next.
Technology, I'm Emily Chang. Let's return to one of our top stories. Jeff Bezos, Warren Buffett, and Jamie Dimon getting into healthcare. Amazon, Berkshire Hathaway, and JP Morgan are planning a new company to provide their U.S. employees with tech solutions for simplified care at a reasonable cost. Shares of insurers and some drug makers fell in Tuesday's session on expectations the venture will eventually be used to challenge long-held industry norms. At the heart of the partnership is a possible solution to the rising costs of healthcare for companies. Our Bloomberg editor-at-large, Corey Johnson, is in New York with a special guest. Corey?
Yes, I am, Emily. Thank you very much. One of the important companies that's starting to look at this business is Ali Diab's company, Collective Health. He joins us right now, founder and CEO of a business that's exactly focused on this problem. Is self-insurance actually possible? As soon as Ali joins us right now, he's in San Francisco, I'm here in New York, and yet we can talk thanks to the magic of technology. Ali, one of the beliefs here is the magic of technology itself can somehow make providing self-insurance for these three really big companies possible in a cheaper way. Is technology the key here?
I think technology is certainly one of the keys. Customer service obviously is important, and you can't really have one function well without the other, but it's certainly been our belief and our experience that technology can drive the kind of change in the healthcare industry more broadly that we're seeing in the announcement today between Amazon, JP Morgan, and Berkshire Hathaway. So yes, absolutely.
All right, so these smart guys, I'll give them credit, Jamie Dimon, Warren Buffett, Jeff Bezos, and I thought that so I figured the whole thing out. They haven't figured it out, but I've figured out what they're going to do. And now you can tell me why I'm wrong. So here's what I think might happen. That Amazon might think about, hey, we've got some licenses to provide drugs in certain states. People wonder what we're going to do with these things. We're good at delivering services and data really quickly. JP Morgan understands pricing, both what people pay and what things can cost. And they have real-time live data about that. Also what balances are across the system, whether it's how much individuals are paying or how much they've got left to spend. And then managing risk and insurance is the core specialty at the heart of Berkshire Hathaway. Do you think that's how this shakes out?
I think that's a good way of characterizing it. I would characterize it more simply as employers want to have more control over how they spend their healthcare dollars and the experience that their employees and families receive as a result of that spend. I think this announcement to me validates what we've been working on for the last 5 years and what we've observed in corporate boardrooms across America during that time, which is employers up to and including the C-suite are fed up with paying for a lot of healthcare costs and getting too little in return, and they want more control. And I think they believe that technology is essential in giving them more control over that experience and over that spending. So, and our success validates that.
Yeah, well, so tell me about this. So explain to us what Collective Health is. Give me the elevator pitch. Although if the jargon alert goes off, I might interrupt you. But please give me the elevator pitch about what you guys do.
Collective Health is a SaaS platform for self-funded employers that enables them to administer their health plans with a lot more clarity, control, and ease than they can get with a traditional health insurance carrier or third-party administrator.
So let's unpack some of that. So in terms of clarity, because I think that's one of the most interesting things about this potential of an Amazon-fueled thing, is what is it that companies and individuals don't know about their own health care?
I think it's not just what they don't know. I think it's what they don't know at the right time.
Right.
And so if you think about the systems that traditional insurance carriers are built on, they're from an era where data analytics and predictive analytics weren't really at the fore of corporate decision making. Fast forward to 2017, that is what drives most corporate decision making, that ability to predict what will happen in the future using big data, machine learning, et cetera. And so for us, we've built our infrastructure from the ground up, not just to process claims and send you an explanation of benefit in the mail, but to actually help you predict and understand what's working, what won't work in the future, right, and then to get ahead of those trends.
So give me an example, like an actual example, something that a company would want to know in time and would now know using that kind of predictive data.
I mean, I think a great example is how people are using things like out-of-network behavioral health benefits. For a lot of our customers, that's a really important thing to enable because behavioral health in particular typically engenders other use of the healthcare system that is non-essential.
Sorry, what's behavior? I should know this. What's behavioral health?
So going to see like a therapist, a psychologist, a psychiatrist. So oftentimes people might have symptoms that are really belying a behavioral health condition, but they'll go to a regular doctor or an emergency room thinking that they have a brain tumor or something far more severe. So that's a good example of using the healthcare system in a way that is very expensive to treat something that actually underlying may actually not be that expensive to treat at all. And our software helps to highlight those kinds of things and enable employers to guide their people to the right kind of care at the right time.
Is it realistic, maybe final question, is it realistic, let's imagine these very big employers of Amazon, JP Morgan, Berkshire Hathaway and all of its, whether it's Mid-America Energy or See's Candy or Geico or what have you. Can we imagine that these three companies with that limited size of a pool could actually lower health costs if they did their own program, just the three of them?
I think if they use collective health, we can definitely help them lower their costs and allocate their spending much more efficiently than they already do.
All right, Ali Diem, thank you very much. Co-founder and CEO of Collective Health, making the pitch, Emily, to those three big CEOs. I'm sure his phone's ready to ring any minute now. Thank you very much.
Thank you for having me.
All right, thanks, Corey. And in the latest tech revolving door, outgoing American Express CEO Ken Chenault is set to join General Catalyst. Chenault will join the venture capital firm as chairman and managing director. It was announced in October that Chenault would leave Amex after 16 years at the helm. He just joined the boards of Facebook and Airbnb, and his appointment is much needed in a VC industry that is lacking in diversity. Coming up, machines are learning faster than ever before, but is your job in danger? We'll look at AI's impact on employment next. This is Bloomberg. Twitter shares continue to surge in Tuesday trading following unconfirmed speculation last week about a potential takeover. Shares climbed nearly 5% to their highest level since November of 2015 and have rallied 18% since Friday. Twitter reports earnings February 8th, and we should also note Bloomberg LP operates a global breaking news network on Twitter called TikTok. Well, the machines are coming for your jobs. Well, that's the fear that many people have as AI and machine learning become an ever-present part of our society. In fact, a recent study by the Pew Research Center shows that 73% of Americans express a feeling of worry over losing their jobs to machines. And a quarter of those surveyed feel very worried. Joining me now to discuss this, as well as the impact of AI on our society, is Luis Perez Breva. He is a professor at MIT School of Engineering and also author of Innovating, a Doer's Manifesto, which is all about how innovation begins with a hunch. Also with us, Bloomberg Tech's Selena Wang. Thank you both so much for joining us. So, Luis, what do you make of the real feeling behind the data in this Pew study? People are scared.
Yeah, and there's been a lot of talk about AI, and to be frank, we hear the word AI associated with so many things. And every single movie out there seems to be talking about AI, and it's always evil. So no wonder people are concerned. But the real concern is they're confusing AI with automation. And automation is not AI. Automation is actually what makes us humans. We've been doing automation forever. Monkeys don't do automation.
What's the difference between AI and automation?
Well, we make things, machines that make things simpler for us so we can do something else. That's the whole point of investing in technology. And The real issue here is that if they're worried, they shouldn't be worried about the technology. It's about business. We need to make better businesses that actually use this technology and AI to take advantage of the automation and create new jobs. That's the whole point of AI, actually.
It's interesting that at the same time AI is advancing, you have companies like Facebook saying they have to hire 10,000 people to do the job that AI still can't do.
Exactly. I think there's a really interesting example here. We have a case study of terrorism and abuse online. We've seen Facebook and Twitter invest a lot in machine learning algorithms to try and catch that. Yet we're also seeing them simultaneously hire thousands of people to manually catch that. And even though we have thousands of human workers trying to do this in combination with AI, it's still not enough. And I also think it's interesting that you have tech luminaries like Elon Musk tweeting regularly about sort of these apocalyptic narratives about AI.
I have that tweet from Elon Musk saying, China, Russia, soon all countries with strong computer science, competition for AI superiority at a national level, most likely the cause of World War III. Same time, Mark Zuckerberg has responded to these apocalyptic warnings. Take a listen to what Zuckerberg had to say.
With AI especially, I'm really optimistic. And I think that people who are naysayers and kind of try to drum up these doomsday scenarios are I don't understand it. I think it's really negative, and in some ways I actually think it's pretty irresponsible, because in the next 5 to 10 years, AI is going to deliver so many improvements in the quality of our lives.
Luis, is AI going to be the end of the world or not? Who do you agree with here?
I don't think so. I like to think of technologies about how hard it is to bring a technology to the world. So think about Bitcoin. Bitcoin, just about last week, was predicted to use as much energy as the entire United States in 2 years. So how are we going to power that super evil robot if we cannot even power a single Bitcoin currency? So there's a lot of questions there. And people, naysayers and so on, are forgetting, I agree with Mark Zuckerberg, that there is a lot of problems we can solve now because we have AI.
So we're seeing companies like Google, Amazon, Facebook invest heavily in AI, and they've made strides in areas like speech recognition, driverless cars. But how far along are they really? And are they achieving anything like general AI intelligence?
No, general AI is a dream right now. I'm not
What
even
is general AI? Define that.
The idea that we could have a computer that interacts intelligently with us, the way I dream of it is like Jarvis in the movie Iron Man, the artificial intelligence that helps Iron Man become the superhero he is. That's the kind of AI I want. That's a dream. We're getting close.
We're getting close.
We're getting close to being able to imagine it, right? We're nowhere close to actually building that. But we can do lots of good with it already, with what we have.
But who is the closest to building that, if you had to say?
I don't know, bring me an entrepreneur from 60 years from now, and then I'll tell you.
What about countries? Obviously, China is investing $100 billion in AI. Who's ahead when it comes to the global race to do this? The U.S., China?
There's so many things are being called AI today. Big data, analytics, machine learning. So when people say China is investing in AI, they're actually really investing in robotics, big data, analytics, which are mostly technologies that have been known and are being used for 30 years. So the really new technologies, which is starting to use AI to solve real problems, is what US companies are starting to struggle with to bring it out of the web and into the world. And I would say the US still has the lead using that, using it in other domains of science. What we're seeing other countries do nowadays is things that the United States started doing 20, 30 years ago.
But what about some of the risk factors associated with this? I mean, we have a recent example where Facebook created this AI engine that started going wild and creating a language that humans couldn't even understand.
Yeah, I think that was slightly exaggerated. So we have a computer that produced a bunch of gibberish talking to another computer. I'm not even sure they were really talking to each other. Much like Siri, think about Siri. It's eerily human, mostly because it's been trained to look eerily human, but it's not intelligent, right?
So if there is something to worry about when it comes to AI, what is it?
I'm not particularly worried about AI. I'm actually very optimistic. I love AI. I love to use it for real-world problems. I'm more concerned about hacking, about security, about our data floating about with subpar machine learning algorithms. That scares me more than the AI itself.
So AI getting too far ahead of itself, is that what you mean?
Not so much. It's hackers that don't need any AI, human intelligence that finds backdoors into systems more than the AI itself.
All right, Luis Perez Breva, professor and research scientist at MIT School of Engineering. Thank you so much for joining us, as well as Bloomberg Tech's Selena Wang.
Thank you.
Coming up, Samsung gets ready to report its final fourth quarter results. This as investors worry about waning chip demand from smartphone makers. We head to Hong Kong for the full report next. This is Bloomberg. Toy-making giant Mattel is taking another shot at turning its iconic toy lines into mobile games. Mattel is entering into a joint venture with China's second-largest video game company, NetEase. The new studio, dubbed Mattel 163, will debut their Uno card game on Facebook Messenger, Android, and iOS early this year. They also plan to work on such classic Mattel lines as Barbie and Fisher-Price. Well, Samsung is getting ready to deliver its final fourth quarter results in the coming hour. The stock has taken a hit, falling over 2% ahead of Samsung's report. Joining us now from Hong Kong to tell us why, Bloomberg's Chief North Asia correspondent, Stephen Engel. So, Stephen, what should we be looking for in these final fourth quarter results?
Yeah, these are the final results where we're going to get net income and also the breakdown of the various divisions like chips and also displays, which have done really well. I mean, it was a record full year, keep in mind, for Samsung Electronics, supplying that Apple iPhone supply chain, of course, with the OLED screens and also the memory chips. But the big problem in the fourth quarter was that surging yuan against the dollar. It surged 7% against the greenback in the fourth quarter alone. And I was looking at some statistics from CLSA. They say that for every 10 won increase or movement on the won, that affects operating profit by some 200 billion won or 186 million US dollars. And CLSA says that was about 600 billion won in the fourth quarter alone. So despite all the surging or fairly stable contract, supply of those screens and chips to the likes of Apple, the won really hurt them in the fourth quarter.
Though Apple is working on its own chips, Samsung still a big provider of chips for Apple products, including the iPhone. Is there concern about waning chip demand, especially amidst concern that the iPhone 10 isn't selling as well as some would have thought?
Well, that had been the Hynix, which is the number 2 memory chip maker. Hynix and Samsung control more than 2/3 of the DRAM market, supplying to the likes of
46% from the prior year. Most of that revenue comes from mobile advertising. In this quarter, it'll likely see a boost from people watching video ads, as well as ads on Facebook-owned Instagram, which is edging closer to 1 billion users. Still, some analysts are concerned about the future. In response to all the criticism about Facebook's newsfeed, CEO Mark Zuckerberg has announced a major change to show more posts from family and friends and less from media and brands. It's a move that could potentially lead to less engagement on the site. And the company has to prove it can build out new businesses. Facebook's investing a lot in original content to show it can compete with YouTube. But will those new kinds of video ads work? When will Facebook start making serious money off of Messenger or WhatsApp? We'll stay tuned for answers and any surprises when Facebook reports after the bell on Wednesday. I'm Sarah Fryer, Bloomberg News, San Francisco.
That does it for this edition of Bloomberg Technology. We will have full coverage and analysis of Facebook's results, plus earnings from Microsoft and Qualcomm on Wednesday's show. A reminder, we are live streaming on Twitter. Check us out at Technology weekdays, 5 p.m. in New York, 2 p.m. in San Francisco. That is all for now. This is Bloomberg.